Hello and welcome to this very special show on the Economic Survey 2026, which is going to get tabled just a few minutes from now. This is ET Now, and you're at the headquarters of the Budget 2026. I'm Harsh Saita, with me is Snehisha, and over the next hour or so, we'll try to dissect that survey, which gets released in just another few minutes. We'll also have the FM speaking, so we'll have all of that coming in live to you. But at this point, Aditi Nayar joining us, Chief Economist at ICRA, to talk to us about what she is likely going to pencil in with regard to the economic survey. Hi, Aditi, good morning. Historic day, of course, but talk to us about what you're penciling in. What's the expectation likely looking like? Give us a quick recap before we get to looking at the fine print of what the economic survey is saying.
Thank you so much. Important day indeed. This is actually a very interesting juncture that we are at. We are projecting for next year based on the current basis that we have both for the CPI and the IIP. But actually, we are going to be moving to new base years for both of these very critical indicators in the next 1 month. So as of now, we are doing forecasts for FY27 on the existing basis, and we're looking at a real GDP growth that's probably likely to be around 6.7% in FY27, and we're penciling in a 9.8% nominal GDP growth for next year. So we'll be looking at what the Eco Survey projects in this context, of course, keeping in mind that our forecasts are on the existing base, and numbers may well change, growth rates and levels could be quite different once the new figures come in at the end of February. And with the CPI as well, as of now, we're looking at the CPI doubling from 2%, which is right at the lower end of the MPC's forecast range in FY26, back to a normal sort of 4% or thereabouts in FY27. So there again, what the Eco Survey indicates, any hints which are there for the fiscal trajectory, we're now moving to the debt to GDP being the nominal anchor for the fisc, moving away from the strict fiscal deficit to GDP targets. So what hints does the Eco Survey give for what we can expect on Sunday in terms of the debt to GDP, the fiscal deficit to GDP, what it means for borrowings? I think the bond markets would be particularly interested in that.
Okay, so lots to watch out for. Aditi, hi. Talk to us about your outlook in terms of what the key themes could be in this economic survey. Last year, private participation in Capex was a big talking point. Are you expecting to hear anything along those lines this time too?
Definitely. I think, the hint that's been given is that the survey has been reorganized and it's longer than it used to be. So I'm assuming that lots of different topics are going to be covered in the survey. So very difficult to wager a guess, what exactly is going to find coverage, but possibly some discussion on the reforms in the agri and the non-agri sectors, maybe some discussion of PLI and other ways of spurring domestic manufacturing. What really can India do with the global environment becoming more and more uncertain with every passing month? Any future direction on trade deals, especially with the US. These are possibly some topics that we could see. The state finances report that just came out from the RBI talked a lot about demographics and transition. So maybe that also could be something that the Eco Survey may discuss, because obviously India is on the cusp of a lot of demographic change. So perhaps that's something that could find a mention in this year's Eco Survey as well.
Okay, we'll have, in fact, the finance minister speaking in just a minute or two from now, so we'll have to hold those thoughts, Aditi. But essentially, viewers, it's going to be about what is the tone and the tonality of that eco survey that comes out. Is it going to be a more bullish tonality with regard to growth, with regard to jobs, with regard to tech? And of course, then how does spends play out? Defense, Capex, what changes are essentially made, and how the government also views consumption trends at this point, given all of the impetus that's been given over the last 12 months with regard to consumption, both on the income tax front as well as on the GST front. Huge SOPs given to that extent, 2.5 lakh crore is the total extent of that. Also, the other key piece or the key moving part is also going to be the divestment target of the government. What is it that they are forecasting with regard to divestment? Is there going to be a hint of acceleration with regard to divestment? Aditi, how does one manage all of those moving parts in your opinion?
Look, hints definitely could be there in the eco survey, but the final word will come in the budget on Sunday in terms of specifics for things like disinvestment. While there could be some cues, it's not necessarily that the budget is going to be very aligned with things like, the outlook for disinvestment, because the eco survey is going to give more of a policy framework or a medium term kind of outlook, but what the market realities are for the current year may be a little different, and the budget would probably more take a cue from what would be realistic for the current year. But yes, the eco survey will give a more overarching sort of policy focus on topics like this. Now, specifically, like you mentioned, expenditure management, I think that is very important right now, because we are looking at the CSS schemes having moved to a different system, a just-in-time cash release system, over the last couple of years, and that has had an impact on the way that the expenditure is getting, the pace at which
Copy each of the following papers, Hindi and English versions. Economic Survey 25-26, Economic Survey 25-26, Statistical Appendix.
Item number 3, Sri K. Ram Mohan Naidu.
माननीय अध्यक्ष महोदय, आपकी अनुमति से मैं अपने सहयोगी की ओर से आज की कार्यसूची में क्रम संख्या 3 पर उनके नाम के समक्ष उल्लिखित कागजात सदन के पटल पर रखता हूं।
Item number 4, Mahasachil.
Sir, I lay on the table the following 4 bills passed by the Houses of Parliament during the 6th session of the 18th Lok Sabha and assented to by the President since a report was last made to the House on the 2nd December 2025. 1. The Manipur Goods and Services Tax, Second Amendment Bill 2025. 2. The Central Excise Amendment Bill 2025. 3. The Health Security Say National Security Cess Bill 2025. 4. The Appropriation Number 4 Bill 2025. I also lay on the table copies duly authenticated by the Secretary General Rajya Sabha of the following 4 bills passed by the Houses of Parliament and assented to by the President. 1. The Viksit Bharat Guarantee for Rozgar and Ajivika Mission Gramin VBG Ramji Bill 2025. 2. The Repealing and Amending Bill 2025. 3. The Sustainable Harnessing and Advancement of Nuclear Energy for Transforming India Bill 2025. 4. The Sabka Bima Sabki Raksha Amendment of Insurance Laws Bill 2025.
Item number 5, Sri Kiren Rijuji.
Speaker, sir, I rise to present the 13th report of the Business Advisory Committee.
माननीय सदस्यगण, मुझे बताते हुए अत्यंत प्रसन्नता हो रही कि भारत की संसद द्वारा 14 से 16 जनवरी 2026 के बीच राष्ट्रमंडल देशों की संसदों के अध्यक्षों और पीठासीन अधिकारियों CSPOC का 28वां सम्मेलन सफलतापूर्वक आयोजित किया गया।
Okay, we're also joined, and we'll obviously keep you updated with regard to all that's happening in the Lok Sabha. Those were live visuals from the Lok Sabha today. We're also joined by Mr. M. Govinda Rao, who is a former member of the Economic Advisory Council to the Prime Minister. Mr. Rao, a $5 trillion economy, at least the IMF expects this to happen in 2028. We'll breach that $5 trillion mark. What could possibly accelerate that, if I can ask you? What's the view with regard to how quickly the economy can grow?
Well, the most important thing is to accelerate the investment. In fact, what has happened is that investment has been sort of stagnant at around 30-31% of GDP. And unless and until you push the investment, you are not going to accelerate the growth in the medium and long term. And to do that, you will have to reduce the cost of capital. You will have to improve the ease of doing business. You will have to sort of open up the economy for foreign direct investment to come in. So there are a number of things that we need to do if we really have to, sort of accelerate growth. More than achieving the $5 trillion, because $5 trillion is not a major issue. Because today, if you see in terms of the per capita income, we are 136 out of the 190 odd countries. So we will become the third largest economy by, sort of 2028. But that's not enough. We need to really, if we are really looking for a Viksit Bharat in 2047, substantial increase in rate of investment is necessary, and we need to, at the prevailing capital output ratio, incremental capital output ratio, we need to achieve the investment rate of somewhere about 40%. Unless and until we do that, we are going to be very difficult, and that requires a large number of, reforms in order to reduce the cost of capital, in order to improve the competitiveness of the economy, and in order to attract, global trade and investment.
Okay, lots to watch out for. Clearly, in a few minutes from now, we're going to be hearing out from the Parliament itself. But we also have Mr. Swaminathan Aiyar, consulting editor at ET Now, joining us on the show. Swami, sir, thanks so much for joining us. Talk to us about your pre-budget and pre-economic survey estimates. What are going to be some growth targets or some focus areas in this speech, according to you?
I do not expect this to be a budget that will be remembered. We are not in a mood, I would say, as far as the political economy is concerned, for any radical changes at this point. We are facing a very turbulent situation, and 100% I would say the world economy is going to slow down in 2026, and India will have to slow down. We may want to accelerate. You can take a long-term target and say what all is required to get to Viksit Bharat targets. But the current position is, what is the situation domestically and globally? Domestically, the situation looks beautiful. Goldilocks economy, very fast growth, 8% in the first half, and inflation so low, 2% or below. So it's a Goldilocks economy, but the external environment is extremely unfavorable, not just a little bit. So let us see what is going to, you see the IMF forecast, you look the World Bank, everybody agrees that the world overall is going to slow down in 2026, and India is not going to be exempt from that trend. Therefore, I would say in the coming year, we need to hunker down and say there are going to be lots of storms. We don't know exactly what is going to happen, in which direction. We don't know what new 25% duty Mr. Trump may give, or what some concession may come from some other place. Maybe we'll be lucky and the Ukraine war ends. Maybe it gets worse. There are so many unknowns that I would say this is not a time for experimentation. This is not a time for going around thinking what radical changes can we make. In these circumstances, when the whole world economy is coming down, Mr. Govinda Rao just said, what about increasing investment? If I am a businessman and there are so many uncertainties and the world economy is going to slow down, is this a time when I'm going to invest more just because there is a Viksit Bharat target? No. I would say this is a time for caution, for hunkering down, watching what the storms are going to come, and then move forward cautiously. We have done very well in 2025-26 to have achieved so much growth. If we can just stick to that kind of path, hopefully we will withstand the winds that we are going to see in the coming financial year. But do not see this as a year where you can expect rapid or accelerating growth. Just the other way around. I would say the global circumstances are such, we are going to slow down. So let us be cautious and careful about it and not embark on various adventures.
Okay, so those are views coming in from Swami, sir. We are also joined by Radhika Rao, Senior Economist and Executive Director at DBS Bank, joining us from Singapore. Great having you, Radhika. Opening thoughts. And by the way, guests as well as viewers, the economic survey is actually out now, so we can start looking at the numbers. But Radhika, just very quickly, first your initial thoughts with regard to what to expect. Okay, Radhika, I believe you're on mute.
Am I?
Okay,
No, you
you're
can't
good.
hear me.
Please go.
Okay.
Yes.
Yeah, okay. Sorry, so I was just saying that initial numbers, I mean, yeah, it's already flashing in your screen, which is the growth numbers, which is about 6.8 to 7.2. That is probably a shade better than where the street estimates are, but still very much doable. And I think taking on from what the other panelists were also mentioning, I think the important thing will be where is this growth coming from? And certainly I do think that the playbook has essentially changed in the last year and a half. And from that point of view, much growth will be seen coming from the domestic drivers, especially consumption and investments. And I think in the budget as well as outside of it, we will hear a lot of, I would say, encouraging narrative or commentary from the government to say that they will play their part, especially because certainly private sector might face one more year where things are not that upbeat because of what's happening globally and what's happening to the currency as well. So in that light, I think it will still be the government that will lead from the front. But certainly they want even sectors like defense, for example. There is some amount of room that they can invest in, but they will expect beyond a point that the private sector will participate as well. So in a nutshell, this is what we'll be looking for. And I think economic survey sometimes has some suggestions which are taken up by the budget, but by nature it is not prescriptive. So I think it does give a very good idea on where the CEA sees some of the main changes that needs to come about on the FDI front, on on the investment front, as well as exports. And I would assume this time around there might be, I've not seen the document yet, but some chapters on FTA and global supply chains as well.
Okay, so these are some of our initial takes coming in. The Indian economy expected to grow by 6.8% to 7.2% in FY27. Just some initial lines that we're reading off the economic survey, wherein it said that FY27 is likely to be a year of adjustment. Of course, this is in light of the changing mechanism of the metrics that we're going to be looking at to calculate growth going ahead. Aditi, quick take on this number, 6.8 to 7.2. What are you making of it?
So like I said earlier, we are projecting baseline real GDP growth at 6.7% for next year. And this, of course, is on the prevailing base. So the 6.8 to 7.2% number, which is effectively anchored around 7%, is a little bit higher than what we were projecting. And I echo, a lot of what Swami sir said earlier. This is going to be a year which is rife with uncertainty, especially on the external front. And we've had a lot of stimulus coming in from the tax relief over the last year. We've already had policy rates being lowered by 125 basis points as well. Now consumption has to respond and sustain. On the investment side, our view is that the private sector is investing, but very unevenly. And I'm not sure that it's going to necessarily broad base in the current global uncertainty. So it'll be quite interesting to see now what the expenditure mix of Government of India and the state governments is. Government of India will know on Sunday. I am hoping that whatever fiscal space is there is going to get prioritized more toward capital expenditure that is going to have a higher multiplier impact and not necessarily on revenue expenditure that tends to have a lower multiplier. But for the state governments as well, with the Finance Commission report, the government already has received it a few months back, but we don't know what the recommendations are. They'll only come into the public domain along with the budget on Sunday. So after that, we'll get a better sense of what the states are going to be able to do within the new fiscal sort of constraints that they have next year. And definitely government expenditure will have to play a role in sustaining a growth of 7% or higher than that.
Mr. Rao, if I can come to you, the 6.8 to 7.2, how do you view that number? Looks ambitious or looks doable? And if it looks ambitious, what will be required from the government in terms of stimulus to achieve that?
I think 6.8 to 7.2 is on the higher side. It's an ambitious target. Of course, there's nothing wrong in having an ambitious target, but then it requires a lot more of work to be done. Partly because much of the growth in the last couple of years has been driven by domestic consumption and sort of public sector investment. Now, public sector investment has been quite high in the last couple of years, but the problem is that there are the fiscal constraints. I mean, if you are going to contain your debt to GDP ratio to 50% in 2030, then obviously you will not have so much of a leeway to, sort of spend more and more in capital expenditure. And even at the state level, I think the fiscal situation has substantially deteriorated in the last few years, because the prioritization has been on basically social welfare expenditures. Now, as a result, what has happened is even spending on education and healthcare has not been, has been going down. So in that particular situation, increasing capital expenditures is not going to be, it's not going to be a major sort of item in the agenda for the states. Now, in a situation like that, I don't know, sort of major drivers. Of course, there are issues like what will happen to weather and various other things, but then 6.5% is a normal growth we can expect, but then 6.8 to 7.2, I think is a bit of an ambitious target.
Okay, so an ambitious target. It's all eyes are going to be on whether at the end of this fiscal year we're able to achieve this band of growth or not. But Radhika, talk to us about this one line that really stands out to me from the economic survey, and it talks to it says in terms of bearing systemic shock and seeing the transfer of financial stress, India needs to run a marathon and a sprint at the same time. What are you making of this line?
Hi, I think this could be referring to, generally the volatile financial markets outside of India. We have seen quite sharp moves in the dollar. We have seen very sharp moves in the precious metals universe. There's a lot of talk about debasement, de-dollarization, and the impact on India has been very varied in the sense that, even though the dollar has corrected a lot, rupee has been under pressure. In fact, today as well, rupee has weakened to a record low. So I think I would say this, and the takeaway for me is that we have to keep the external vulnerabilities low and sufficient buffers in place, because this is in the long run. Some of this could be momentum based, some of these could be one-off factors. But I think when you look back at the economy and look at does it have enough cushion, that is always very important. And I think at this point, I do think what's happening on the currency front, for example, to some extent, it's very, very flows driven. We have current account is in decent health. We have seen reserves actually been partly because of valuation effects, but stay strong. External debt is within control. So in those terms, I would say the buffers are sufficient. But sometimes, again, because of flows, again, some part of these flows are outside India's control, in the sense that there are some thematics that are playing out. There is some regional, I would say, regional drivers that are, attracting more flows. So from that point of view, for my takeaway from this sentence would be that we have to keep an eye always on the macro stability indicators. Keep them, sufficient. We don't have any risk, any of the vulnerability indicators getting weakened. And I think from that point of view, I would be actually looking for comments, if any, on the currency as well. What does the economic survey make of it? Do they see that as a structural issue, or do they see that as a support to exports down the line? My take is that, just a currency depreciation alone, that kind of a comparative advantage is difficult in an environment when at least some of the key imports or key exports that India does also has high import dependency, to mean that, that pass-through of costs will come in first before these can be exported out. So I don't think the currency alone, can be used fully as a comparative advantage. It can be kept at competitive levels, but sometimes this can turn into a vicious cycle as well. So this is what I would think these comments are referring to.
Okay, panelists, we're going to have to take a pause here. Swami sir, good to have you back. I'm very tempted to ask you a question, but I'm going to have to take a mandatory break. Let me do that. Let me go dip into that commercial, come back and ask you with regard to your thoughts, with regard to that growth number that we're penciling in and what India will need to do to achieve that. Stay tuned, viewers.